Hey everyone, today we're mastering MACD the right way. You know that feeling, right? Staring at a chart, totally paralyzed, wondering if that big move is for real or if you're about to get wrecked. Well, today is the day we stop guessing. So here's the game plan. In the next few minutes, we're going to take all that messy price action and turn it into a super clear story about trend, momentum, and timing. By the end of this, you'll know exactly what to look for, what to ignore, and how to build a real strategy around this incredible tool. But first, a quick warning, because MACD is probably one of the most misunderstood indicators out there. So many people treat it like a magic crystal ball, and they just get absolutely chopped to pieces in sideways markets. We're not going to do that. Today, we learn to use it like a pro, as a framework for making sharp, clear decisions. And you're definitely going to want to stick around till the end, because I'm giving you a practical checklist you can use on any chart, anytime. Okay, before we get into the good stuff, just the standard disclaimer. This is all for educational purposes. It is absolutely not financial advice. Every market has risks, so please always do your own research. All right, let's do this. So what is MACD, really? I mean, it stands for Moving Average Convergence Divergence, which sounds complicated, but it's not. All it does is measure the relationship between two moving averages to show you what's happening with a trend's momentum. Think of it like this. A car can still be rolling forward, but if the engine is losing power, you want to know about it, right? Well, MACD is basically the tachometer for market momentum.
Now, to read that meter, you got to know what the different parts are. And there are three core components we need to break down. You've got the MACD line, the signal line, and the histogram. Each one tells you a different piece of the story. First up, you've got the MACD line itself. This is really the heart of the whole thing. It's just the distance between a fast 12-period moving average and a slower 26-period one. Now, these are exponential moving averages, or EMAs, which just means they pay more attention to recent prices so they react faster. When this line moves away from zero, it means short-term momentum is picking up. When it falls back towards zero, momentum is fading. Simple as that. Next up is the signal line. Its only job is to smooth out the MACD line. It's basically an average of the momentum itself. Now, when the MACD line crosses over the signal line, that's what everyone talks about. But here's the secret. A crossover is a yellow light, not a green light. It's just information. It's the market telling you, hey, pay attention. It is not a command to buy or sell. Trust me, knowing that difference will save you a world of pain. And finally, we get to my favorite part of the indicator, the histogram. These bars might look simple, but they are so powerful. They just show you the distance between the MACD line and the signal line. When the bars get taller, it means momentum is accelerating. The trend is getting stronger. And when they start shrinking, that means momentum is fading, even if the price is still moving up. And this right here, this is the pro-level insight. The histogram is your early warning system. It will often show you that momentum is getting weaker before the lines even cross. This gives you a massive head start on what the rest of the crowd is about to see. It's a total game changer. Okay, so we've got the components down. Now let's see how they work together to create the four major signals that actually tell us the market story. This is where we turn all that data into actual decisions. So we're watching for four key things. First, crossovers, which show a shift in momentum. They work best during pullbacks in a clear trend. Second, the zero line, which gives us the overall trend bias. Think of it this way. Above zero, the bulls are in control. Below zero, the bears are. Third, the histogram, which we just covered, our early warning for momentum speeding up or slowing down. And finally, divergence. That's when price and momentum start telling you two different stories. Now let's dig into divergence because it's super powerful, but people get it wrong all the time. Regular divergence is a huge warning sign. Price makes a new high, but MACD makes a lower high. That means the buying pressure is fading, the trend is getting tired. Hidden divergence is the opposite. It's a clue that a pullback is probably over and the main trend is about to kick back in. But here's the most important rule. Divergence is an alert, not a trade signal. You always need to wait for price to confirm the idea. Okay, this might be the most important slide in this entire explainer. MACD is a trend-following tool. It absolutely shines when the market is moving with clear direction. That is an MACD-friendly market. The MACD trap, on the other hand, is a sideways, choppy, ranging market where price is going nowhere. In that environment, this indicator will give you one false signal after another, just bleeding your account dry. Context is everything. So, knowing the right context is the key to avoiding the traps. The truth is, most traders who lose money with MACD lose it not because the tool is bad, but because they're just using it completely wrong. Let's break down the biggest mistakes so you can sidestep them completely. Here they are. Number 1, trading every single crossover. In a choppy market, that's a recipe for disaster. The fix: identify the market state first. No trend, no trade. Number 2, ignoring the zero line. That line is your filter. If you're looking for buys, you want to be above it. Sells, you want to be below it. Fighting the zero line is a tough game. Number 3, treating divergence like a guaranteed reversal. Remember, it's just a warning. The trend can stay tired for a long, long time. Wait for price to prove it's over. Number 4, having no stop loss based on price. Your indicator doesn't tell you where you're wrong. Price action does. And finally, the biggest one, believing MACD can predict the future. It can't. It's a tool for understanding the present, not for fortune telling. Okay, we've covered the theory, the parts, and the pitfalls. Now for the most important part, your action plan. This is the systematic checklist that's going to stop the guesswork and get you analyzing charts with absolute clarity.
Go ahead, pause, and screenshot this checklist. I'm serious. If you actually use this, you will stop making the same expensive mistakes over and over. Before you even think about placing a trade, go through these 6 steps. 1, what's the market state? Trending or ranging? 2, am I on the right side of the zero line? 3, what's the histogram doing? Is momentum on my side? 4, is the signal happening at a key price level? 5, do I have a clean trigger that's confirmed by what the price is actually doing? And number 6, the most important of all, what's my risk plan? Where's my entry, my stop loss, and my target? This is how you turn MACD from a random signal generator into a professional decision-making tool.
We covered a ton of ground today, but if you just stick to that checklist, you'll be light years ahead of the competition. If this explainer helped you get some clarity, do me a huge favor. Please like the video, subscribe to the channel, and leave a comment. It really, really helps us out. And to wrap it all up, I've got a question for you. Which MACD signal do you trust most and why? Is it the crossovers, the zero line, the histogram shifts, or divergences? Let me know your answer down in the comments below. Thanks for watching, and I'll catch you in the next one.